going to quickly walk us through how to record all of these transactions into T-account form. Very first thing you always want to do is to determine whether any of the accounts have a beginning balance before we post any transactions. And they tell us three accounts do: raw material, work in process, and finished goods. These are all asset accounts. They're inventory accounts. So what I've got over here are all of my different T accounts we'll end up using. And they told us that the raw material accounts start out with a $9,500 balance. The work in progress account started out with a $17,900 balance. And the finished goods account started off with a $20,000 balance. Okay, so that's where we start. And then we go through each transaction and we figure out how it affects the accounts. So raw material were acquired from suppliers on account for $18,500. So my raw materials should logically increase. And I didn't pay them with cash. I bought it on account, which means my accounts payable also increases. So that's the first one. I should maybe make a little notation here as to which transaction this came from, if I ever have to go back and I'm wondering. So the second transaction, B, raw materials were requisitioned, meaning they were used or pulled out of the warehouse for production. In total, $22,000 left the warehouse. Some of it went as direct material and some of it went for indirect material. That's all we know. So what we know is raw material decreased by $22,000. That came from transaction B. And some of it went to production. The part that went to production goes to work in progress. And I think they told us it was 80%. So we'd multiply that 22,000 times 80%. And that's how I came up with 17,600 goes to work in progress. Debits have to equal credits for every transaction we enter. And the remainder, the 25%, is indirect, goes to overhead. So we take $22,000 times the 25%. $5,500 goes to this overhead account. Actually, I used the wrong percentage. It wasn't 25%, my bad. It's 20%. So it's $4,400. And I would know that if I were looking up each transaction to make the debits, make sure debits equal credits, and now they do. This plus this on the debit side equals what I credited. Okay, so that's transaction B. Transaction C says we accrued payroll, meaning people worked. We haven't paid them yet, but we accrue it, so we're going to expense it at this point. So we have $40,000. Of that $40,000, 75% is direct, 25% is indirect. Again, that's important because it tells us where it goes into the different accounts. So I haven't paid them yet. My wages payable go up by the $40,000. This is from transaction C. We're told that 75% went for production, so $30,000 goes to work in progress. And the other $10,000 goes to overhead. So it's going to sit in this overhead account. That's transaction C. Transaction D, we actually paid cash for all of these different things. We paid cash to suppliers, $18,000. So my accounts payable goes down by $18,000. This is from transaction E. I paid cash for payroll for $40,000. That's going to remove my promise to pay my employees, that $40,000. I pay cash for factory utilities, $6,000. Factory utilities are an overhead component. $6,000 goes to the overhead control account. $12,000 for factory rent. So my overhead account, once again, goes up for $12,000. And I also made a $3,660 miscellaneous payment for factory costs. This also would be an indirect cost going to that overhead control account. So $3,660 for transaction E. And what I should do is take all of those cash transactions and add them up. I've done this ahead of time for us, and that totals $79,660 that we remove from our cash account. And this was from transaction, I think that was actually transaction D. I'm sorry, not E. So these should all be D. Cash transactions. Got ahead of myself there. So D. Okay, let's move on to transaction E. Overhead was applied to jobs on a basis of 115% of direct labor costs. Okay, first off, we need to know what the direct labor costs were. We paid our employees 40 grand, but remember, some of that was for direct and some was for indirect. We knew that 75% of this amount was direct. So $30,000 was direct wages. So we would take that $30,000 and multiply it by that 115%. $34,500 is applied overhead. This is transaction E. Okay, so then the question, and I think this is probably the hardest part of the problem, is where's the offsetting side of the transaction? We applied the overhead, and remember that any component costs go through work in progress, right? Material, labor, and overhead work their way into work in process. So this $34,500 also goes into work in process, and that was for transaction E. So we've applied the overhead. Transaction F, the ending work in process was determined to be 18,000. Maybe they went out and counted the work in process and assigned a value to it. Okay, so now what we're told here is the ending balance is going to be $18,000. Let me just double check that that's the amount. $18,000 is the amount we're going to end with. So that's my ending work in process account balance. So then really this is a matter of understanding how work in process works. We started with 17.9. We increased the account by all of these things. We can't logically end at 18,000 unless we remove from work in process a big chunk. And so we take out the difference between all of these amounts. So if you were to add these up, you would find out that that adds to $100,000. $100,000 minus the ending balance tells me that $82,000 came out of work in process. That makes this statement true. So where did it go? If it left work in process, that means it went to finished goods because the products were then logically completed. So that $82,000 went into finished goods, and I think this was transaction F. The last transaction says the finished goods inventory was determined to be 12,000. So again, someone went out and counted our finished goods inventory, and they said, look, your ending balance is 12,000. So the only way, well, there are several ways finished goods could reduce. You know, inventory could spoil, someone could steal it, those sorts of things. But we'll make the assumption that the finished goods reduced because we sold it. Right? So they got smaller, there are fewer products on the shelves because we sold the product. So what you have to do is say, okay, I started with this, I added this amount, and I ended with the 12,000. So that meant $90,000 left finished goods. And for every credit, there's an offsetting debit somewhere. Double entry accounting works. And so $90,000 goes to the cost of goods sold.